India isn't just building infrastructure. It's rebuilding its future. Every generation witnesses one transformation that quietly reshapes the nation's future. For our grandparents, it was the Green Revolution that changed India's food security. For our parents, it was the economic reforms of 1991 that opened the country to the world. Today, another transformation is unfolding, less dramatic than a stock market rally, yet far more enduring. India is building, not just roads, not just bridges, not just airports. India is rebuilding the very foundation of its economy. Take a drive through almost any part of the country. Whether it's Ahmedabad, Bangalore, Lucknow, Hyderabad, Kochi or Guwahati, the signs are impossible to miss. Expressways are stretching across states, metro lines are reshaping cities. Industrial parks are emerging where farmland once stood, and new housing projects are transforming skylines. At first glance, these may look like isolated construction projects. They aren't. They are all connected by much larger national vision. Over the last few years, government initiatives such as PM Gati Shakti, the National Infrastructure Pipeline, PM Awas Yojana, Smart Cities Mission, and production-linked incentive schemes have all been moving in the same direction, creating an India that can manufacture more, transport faster, urbanize efficiently, and support a much larger middle class. But here's an interesting question. When we hear about a 10,000 crore rupees highway or a new industrial corridor, our attention naturally goes to the engineering marvel. We admire the finished bridge, the airport terminal, or the modern factory. Very few of us stop to ask a much simpler question. Who makes all of this possible? Because before a single brick is laid, thousands of materials have to arrive at exactly the right place, at exactly the right time. Steel, roofing, pipes, electrical cables, paint, plumbing systems, fasteners, construction chemicals. If even one essential material is delayed, an entire project can slow down. Workers wait. Machines remain idle. Costs rise. Deadlines slip. Building a city is surprisingly similar to preparing a meal for a large wedding. It isn't enough to have the ingredients. Every ingredient must reach the kitchen at the right moment. Miss one, and the entire event suffers. Construction works the same way. Factories manufacture products. But manufacturing alone doesn't build a nation. Someone has to connect hundreds of manufacturers with thousands of contractors, retailers, and homeowners spread across an entire country. That invisible connection is often overlooked. Yet history shows that as economies mature, efficient distribution becomes just as important as efficient manufacturing. America experienced it through organized retail and logistics. China experienced it during its infrastructure boom. India is beginning to experience the same transition. As construction activity expands beyond major cities into Tier 2 and Tier 3 India, success is no longer determined only by who makes the best product. Increasingly, it depends on who can ensure that the right product reaches the right customer without delay. This is one of those businesses that rarely attracts headlines. It doesn't produce steel. It doesn't manufacture cement. It doesn't build skyscrapers. Yet without it, many of those projects would struggle to move forward. Markets often overlook businesses like these because our minds naturally focus on what we can see. We celebrate the finished building but rarely think about the network that quietly supplied every beam, every pipe, and every bag of cement. Sometimes, the most important businesses are the ones working behind the scenes. And that brings us to the company at the center of today's story. It doesn't sell dreams. It enables them. Every home, warehouse, factory, and commercial building begins long before construction starts. It begins with a supply chain that works reliably, day after day, often without anyone noticing. Understanding that hidden role changes the way we look at this business. Because this is not simply a story about building materials. It is a story about the network that helps keep India's construction engine running. And before we can judge whether this company deserves an investor's attention, we first need to understand a much more fundamental question. What exactly does this business do? And why has its role become increasingly important in India's next phase of growth? That's where our story continues. The company that doesn't make steel, yet helps build India. Now that we understand why India is entering one of its biggest construction cycles, the next question is obvious. Who is quietly benefiting from it? Most investors immediately think of cement manufacturers, steel companies, or real estate developers. They are certainly important, but they are only one part of the puzzle. Imagine you're building your dream home. The architect gives you the design, but that's only the beginning. You still need steel from one company, roofing sheets from another, cement from a third, plumbing from somewhere else, electrical cables from another supplier, and finally paints, hardware, and finishing materials from dozens of different brands. Now imagine coordinating every manufacturer yourself, finding the right supplier, negotiating prices, managing deliveries, making sure every product arrives exactly when construction reaches that stage. Building a home would become a logistics project rather than a construction project. Most people don't want to manage supply chains. They simply want everything to be available when they need it. That gap between manufacturers and customers is where Shankara Buildpro has built its entire business. Although many people think of the company as a steel distributor, that description tells only part of the story. In reality, the company has evolved into one of India's largest organized retailers and distributors of building materials. Think of it as a supermarket built exclusively for construction. Instead of groceries, its shelves carry structural steel, TMT bars, roofing solutions, pipes, plumbing products, electrical materials, paints, construction accessories, and dozens of other products needed to complete a building from foundation to finish. The business isn't built around selling one product. It's built around solving one problem: convenience. Every construction project moves through stages. The foundation needs steel. The structure needs roofing. The walls need plumbing and electrical fittings. The final phase needs paints and finishing products. Instead of forcing customers to deal with 10 different suppliers, Shankara attempts to become a single trusted partner throughout the entire journey. That creates something far more valuable than a sale. It creates reliability. And in construction, reliability is often worth more than a small discount. A contractor can recover from paying slightly higher prices. Recovering from delayed materials is much harder. Workers remain idle. Equipment sits unused. Project costs increase every single day. Time becomes money. That's why contractors usually don't ask only one question: who is cheapest? They ask, who will deliver exactly when promised? This simple difference explains why distribution is far more than transportation. It is about reducing uncertainty. The company's customer base reflects this philosophy. Large real estate developers source materials for residential projects. Infrastructure contractors purchase in bulk for highways and public works. Industrial customers require structural steel for factories and warehouse. Small builders depend on consistent inventory for everyday construction. Even individual homeowners visit its retail outlets while building or renovating their homes. This diversity is important because no single customer group drives the entire business. If residential demand slows for a while, industrial or infrastructure demand may continue growing. That makes the business more resilient than it first appears. Another interesting aspect is the company's relationship with manufacturers. Shankara doesn't compete with leading brands. It works alongside them. Imagine a car manufacturer launching a new model. Building the vehicle is only half the challenge. The bigger challenge is making sure customers across hundreds of cities can actually see it, test it, and buy it. Building material companies face the same problem. Manufacturing products is one thing. Making them available across India is something entirely different. Rather than investing billions in their own nationwide retail network, many manufacturers rely on trusted distribution partners. Shankara becomes that bridge. Manufacturers gain market access. Customers gain product availability. And the company earns its place by making both sides more efficient. Over nearly 3 decades, that bridge has become stronger. Every new city added experience. Every successful delivery built trust. Every satisfied customer strengthened relationships. Those advantages don't appear separately in the financial statements. Yet together, they quietly shape almost every financial number investors eventually analyze. There's another subtle shift working in the company's favor. Indian consumers themselves are changing. Earlier, people often bought whatever building material was available nearby. Today they compare brands, research products online, and care more about durability, design, and quality. Construction has become more organized. And as markets become organized, trust becomes increasingly valuable. That trust cannot be built overnight. It compounds over years through consistent execution. Which brings us to an important insight. Shankara isn't really selling steel. It isn't selling pipes. It isn't selling roofing sheets. It's selling confidence that every essential material will be available when customers need it. That may sound like a small promise. In reality, it is the foundation on which thousands of construction projects depend. But no company operates in isolation. Its future is ultimately shaped by the industry it serves. So before we decide whether this business has a long runway for growth, we need to step back and understand the larger landscape. How big is India's building material industry? What forces are driving it? And where exactly does Shankara fit within that evolving ecosystem? That's where our story moves next. The industry. Why India's building material story is bigger than one company. To understand where Shankara Buildpro could go from here, we need to step back from the company itself and look at the world it operates in. Because even the best business cannot grow for long if the industry around it is shrinking. Fortunately, that doesn't appear to be India's story. Imagine trying to build an entire city from scratch. Not one building, an entire city. You would need homes, schools, hospitals, warehouse, factories, shopping centers, office. Every one of them begins with building materials. Steel, cement, roofing, pipes, electrical systems, paint, hardware, thousands of products working together to create something much larger than themselves. That's why the building material industry isn't just another sector. It's the backbone of almost every stage of economic development. As countries become wealthier, they don't simply consume more products. They build more assets, more homes, better infrastructure, larger factories, more logistics parks. And India is now entering precisely that phase. For decades, the country's biggest challenge was creating enough jobs and basic infrastructure. Today, the conversation has shifted. The focus is on faster logistics, smarter cities, modern manufacturing, and higher quality housing. This creates a powerful chain reaction. A new expressway doesn't only reduce travel time. It attracts industries. Industries create jobs. Jobs bring families. Families need homes. Homes require schools, hospitals, shopping centers, and commercial spaces. One investment quietly creates demand for many others. Economists call this the multiplier effect. Think of it like planting a tree. You begin with a single seed. Years later, that one seed provides shade, fruit, shelter, and thousands of new seeds. Infrastructure works in much the same way. Its benefits continue multiplying long after the original project is completed. This is one reason governments around the world invest heavily in infrastructure during periods of economic expansion. It doesn't simply create today's growth. It lays the foundation for tomorrow's economy. India's building material industry is also benefiting from another long-term trend: urbanization. Every year, millions of Indians move from smaller towns to larger cities in search of better education, employment, and opportunities. When people move, cities expand. When cities expand, construction follows. And once construction begins, demand doesn't stop with concrete and steel. Modern homeowners want energy-efficient roofing, premium interiors, better plumbing, durable electrical systems, and high-quality finishing materials. In other words, India isn't just building more, it's building better. That subtle shift matters. Because organized suppliers and distributors are often better positioned to serve customers who value quality, choice, and reliable service over simply finding the lowest price. The industry itself is changing too. For years, India's building material market was highly fragmented. Thousands of local dealers operated independently, serving neighborhood customers with limited product ranges. That model worked when projects were smaller. But today's construction projects are larger, faster, and far more demanding. Developers cannot afford repeated delays. Contractors don't want to coordinate with dozens of suppliers. Customers increasingly prefer one reliable partner instead of many uncertain ones. The industry is gradually moving from fragmented supply chains to organized distribution. And that's exactly the environment where companies like Shankara become more relevant. Not because they manufacture products, but because they simplify complexity. Of course, no attractive industry comes without challenges. Construction has always been cyclical. When interest rates rise sharply, home loans become expensive. Developers slow new launches. Construction activity cools. Demand for building materials softens. Then, as financing conditions improve, the cycle begins again. Understanding this cycle is important because short-term slowdowns don't necessarily change the long-term opportunity. They simply remind us that good businesses must survive both strong and weak markets. Another challenge comes from commodity prices. Steel, fuel, and transportation costs rarely stay constant. Distributors must constantly balance inventory, pricing, and customer demand. This is where execution becomes more important than prediction. Nobody consistently forecasts commodity prices. The best businesses simply adapt faster than others. There's also a growing digital influence. Customers compare products online. Manufacturers strengthen direct relationships with large buyers. Technology is making procurement more efficient. But heavy construction materials still need warehouse, logistics, inventory management, and on-site delivery. Technology isn't replacing distribution. It's making efficient distributors even more valuable. So where does Shankara fit into this picture? It sits at the intersection of several long-term trends. Government infrastructure, urbanization, organized retail, premiumization, and India's expanding construction economy. Importantly, it isn't dependent on one single product. It participates across multiple categories, allowing the business to grow alongside the broader construction ecosystem rather than relying on the success of any one material. That gives it flexibility. If one segment slows, another can often offset part of the weakness. It's not immunity from economic cycles, but it is diversification within the same structural theme. By now, one thing has become clear. India's construction story isn't driven by a single highway, one housing scheme, or one government policy. It's the result of several powerful forces working together over many years. And businesses positioned at the center of those forces often have opportunities that extend well beyond the next quarter. But a growing industry alone never guarantees success. Within every expanding market, some companies become leaders while others struggle to survive. The difference isn't the industry. It's the competitive position each company builds inside that industry. So the next question naturally follows. In a market filled with manufacturers, distributors, and organized retailers, why do customers repeatedly choose Shankara Buildpro? And what makes that advantage difficult for competitors to replicate? Why customers keep coming back? The competitive edge that doesn't show up on a balance sheet. By now, we've established two important facts. India's construction industry has a long runway for growth, and Shankara Buildpro has positioned itself right in the middle of that opportunity. But here's the question every investor eventually has to ask. If the opportunity is so attractive, why can't someone else simply do the same thing? After all, distributing building materials doesn't sound like a business protected by patents or breakthrough technology. Anyone can rent a warehouse. Anyone can buy a truck. Anyone can open a retail outlet. So what prevents competitors from taking away Shankara's customers? The answer lies in something Warren Buffett often describes as an economic moat. Think about a neighborhood grocery store. Two shops may sell almost identical products at almost identical prices. Yet year after year, one shop becomes the preferred choice. Not because its rice is different. Not because its cooking oil is unique. People return because they trust the owner, know they'll find what they need, and believe they'll be treated fairly. Over time, that trust becomes more valuable than any single product on the shelf. Businesses work in much the same way. For Shankara, the moat isn't built around one extraordinary advantage. It's built from several ordinary advantages that reinforce each other over many years. The first is its distribution network. India isn't one single market. Building practices differ from region to region. Customer preferences change. Demand changes. Even weather influences the types of construction materials required. Managing that complexity requires much more than warehouse and transportation. It requires local knowledge. Knowing what customers need before they ask. Knowing which products move faster in different markets. Knowing how to keep inventory available without locking up unnecessary capital. That knowledge isn't purchased. It's accumulated. Every successful project teaches the business something new. And over decades, those lessons become difficult to replicate. The second advantage is relationships. Construction is an industry where delays are expensive. Imagine you're building a 500 crore rupees factory. If one critical shipment arrives a week late, hundreds of workers may remain idle while machinery sits unused. The financial loss quickly becomes much larger than the savings from choosing a cheaper supplier. That's why builders often stay with partners they trust. Reliability reduces uncertainty, and reducing uncertainty creates loyalty. These relationships extend beyond customers. Manufacturers also benefit. Instead of investing heavily to build their own nationwide distribution network, many prefer working with experienced partners who already understand regional markets. Shankara becomes valuable to both sides of the transaction. Manufacturers gain reach. Customers gain availability. The company strengthens its position by making both sides more efficient. The third advantage comes from scale. As the business has expanded, its purchasing power has grown alongside it. Larger procurement volumes often lead to better commercial terms from suppliers. Those savings can either improve profitability or be passed on to customers through competitive pricing. Scale creates efficiency. Efficiency improves competitiveness. Competitiveness attracts more customers. And more customers strengthen scale even further. It's a self-reinforcing cycle. Another important advantage is product breadth. Think about how people shop today. Whether online or offline, most customers prefer buying multiple products from one trusted place rather than visiting several different stores. Construction follows the same logic. A contractor rarely needs only steel. Today's steel order often becomes tomorrow's roofing requirement, followed by plumbing, electrical materials, paints, and finishing products. By offering a wide range of building materials under one roof, Shankara becomes more than a supplier. It becomes a procurement partner. Customers save time, reduce coordination, simplify purchasing. Convenience becomes another competitive advantage. There's also an advantage that's rarely discussed outside professional investing. Working capital. At first, it sounds like an accounting term. In reality, it's a measure of operational discipline. Imagine a supermarket. If shelves remain empty, customers walk away. If every shelf is overflowing, cash gets trapped in excess inventory. The best retailers strike a balance. Enough inventory to satisfy demand. Not so much that money remains idle. Distribution businesses operate exactly the same way. Improving inventory management doesn't just strengthen cash flow. It reflects a business that is learning, adapting, and becoming more efficient with every passing year. And perhaps that's the most important advantage of all. Experience. Every city entered, every supplier on board, every successful delivery, every customer relationship. Each one adds another layer of knowledge. Business thinkers call this the learning curve. Simply put, businesses improve by doing. Year after year, small improvements compound into significant advantages. Interestingly, none of these trends would matter if management failed to execute consistently. Unlike technology companies protected by patents or pharmaceutical firms protected by exclusive molecules, distribution businesses must earn their advantage every single day. One late delivery, one inventory mistake, one damaged relationship, and years of trust can begin to weaken. That's why execution is the real product Shankara sells. Not steel, not roofing, not plumbing, execution. When we step back, a clear picture begins to emerge. The company's competitive position isn't based on something dramatic. There is no monopoly, no exclusive technology, no pricing power that allows it to charge whatever it wants. Instead, its strength comes from hundreds of small decisions made consistently over nearly 3 decades. Reliable deliveries, disciplined inventory, strong supplier relationships, a wide product portfolio, operational efficiency, and a growing network that's becoming increasingly difficult to replicate. These advantages don't guarantee success, but they help explain why the business has steadily expanded while many smaller competitors remain regional players. Of course, every competitive advantage must eventually answer one question. Does it create better financial outcomes for shareholders? Because a compelling story is only useful if it eventually appears in the numbers. So far, we've understood why the business exists, why the industry is growing, and why customers continue choosing the company. Now it's time to see whether those trends are actually reflected in its financial performance. Do the revenues, profits, cash flows, and returns on capital confirm the story we've been building? Or do they tell us something different? The numbers behind the story. Do the financials validate the narrative? A great story can attract investors, but only numbers can keep them. So far, we've explored India's structural growth, the company's business model, the industry's long-term opportunity, and the competitive advantages that help Shankara Buildpro stand apart. Now comes the moment of truth. Do the financial statements support everything we've discussed? Or is this simply another compelling narrative that falls apart when examined closely? This is where many investors make a common mistake. They look at revenue, profit, and earnings per share as isolated numbers. Professional investors look differently. To them, financial statements are less like a report card and more like a medical checkup. Just as a doctor doesn't judge your health from a single blood test, investors don't judge a business from one financial ratio. Every number tells part of the story. The real insight comes from understanding how those numbers connect. Let's begin with revenue. At first glance, revenue simply tells us how much business the company has done. But revenue alone says very little. A business can double its sales by offering heavy discounts or by selling products that barely generate profits. Growth without quality isn't real progress. What matters is whether revenue is expanding because demand is increasing, customers are returning, and the business is becoming more relevant. In Shankara's case, the growth appears closely aligned with India's broader construction cycle, expansion of its retail network, and a wider product portfolio, rather than depending on one exceptional year. That makes the growth more meaningful. But revenue is only the beginning. The next question is far more important. How much of every rupee actually becomes profit? Imagine two shopkeepers. Both sell goods worth 100 rupees. The first earns 3 rupees. The second earns 8 rupees. Even though sales are identical, the quality of the businesses is very different. Distribution businesses naturally operate on relatively thin margins. That isn't a weakness by itself. It's simply the nature of the business. The real question is whether margins remain stable or gradually improve while the company continues to grow. When profits rise faster than revenue, it often signals that management is becoming more efficient rather than simply becoming bigger. That's exactly what investors like to see. Efficiency is far more sustainable than temporary growth. One metric that beautifully captures this idea is return on capital employed, or ROCE. It sounds technical, but the concept is remarkably simple. Imagine giving two entrepreneurs 100 rupees each. One grows it into 115 rupees. The other turns it into 140 rupees. Who is the better business operator? Obviously, the second. ROCE measures exactly that. It tells us how efficiently management converts capital into profits. It's one of the favorite metrics of legendary investors because it combines profitability with capital discipline. A company can increase profits simply by borrowing more money, but consistently generating higher returns from the same pool of capital is much harder. Over the past few years, Shankara's improving ROCE suggests that management isn't merely expanding the business. It's extracting more value from every rupee invested. That's often a sign of operational maturity. Closely related to ROCE is return on equity, or ROE. While ROCE evaluates the entire business, ROE focuses specifically on shareholders' money. Think of it as asking a simple question. If I invested 100 rupees into this business, how effectively would management put my capital to work? Healthy and improving ROE generally reflects disciplined capital allocation rather than aggressive financial engineering. Speaking of capital allocation, this is one of the least discussed but most important responsibilities of management. Every year, businesses generate profits. The real challenge isn't earning that money. It's deciding what to do with it. Should it open new stores, expand warehouse, reduce debt, pay dividends, buy back shares, or simply hold cash for future opportunities? Great management teams understand that every rupee has an opportunity cost. Investing in the wrong project destroys value. Investing in the right one compounds it for years. This is why professional investors often say that capital allocation is management's ultimate report card. Another area professionals watch very closely is cash flow, because profits can sometimes be influenced by accounting assumptions. Cash is much harder to manipulate. Imagine selling a car today, but agreeing to receive payment 2 years later. Technically, you've made a sale, but your bank account hasn't changed. Businesses work the same way. That's why strong operating cash flow gives investors confidence that reported profits are being converted into real money. Closely connected to cash flow is working capital. Earlier, we compared inventory management to running a supermarket. Now let's complete that thought. Imagine a supermarket with empty shelves. Customers leave disappointed. Now imagine another supermarket where every shelf is overflowing with products that nobody buys. The owner has plenty of inventory, but very little cash. Neither situation is healthy. The best retailers balance availability with efficiency. That's exactly what working capital measures. It tells us how efficiently a company manages inventory, receivables, and supplier payments while keeping the business running smoothly. One of the encouraging signs in Shankara's journey has been its improving working capital discipline. Inventory turns have become more efficient. Cash is circulating faster through the business. And that matters because businesses don't fail only due to lack of profits. Sometimes they fail because cash gets trapped inside operations. Another encouraging aspect is the company's balance sheet. Growth often tempts businesses to borrow aggressively. Debt can accelerate expansion during good times, but it also magnifies problems when business conditions weaken. Think of debt as driving a car at higher speed. If the road remains smooth, you reach your destination faster. If conditions suddenly change, the consequences become much more serious. Shankara has largely avoided excessive leverage. Its relatively conservative debt profile gives management flexibility during both strong and weak economic cycles. Flexibility is an underrated competitive advantage. Then there's ownership. Professional investors don't just study the business. They also watch who owns it. Promoters increasing confidence in the business, institutions gradually building positions, and long-term shareholders remaining invested often indicate confidence in management's execution. Of course, ownership alone never proves a company is attractive. But when ownership trends support improving business fundamentals, they strengthen the overall investment narrative. Finally, let's connect everything together. Revenue growth, improving profitability, higher returns on capital, better working capital management, healthy cash generation, conservative leverage, disciplined capital allocation. Notice something interesting. None of these factors alone make a great investment, but together, they begin to reinforce one another. This is what Charlie Munger often called a lattice work of evidence. Instead of relying on one brilliant indicator, you build conviction by allowing many independent pieces of evidence to point in the same direction. That's exactly what seems to be happening here. The business story supports the industry. The industry supports the financials. The financials support management's execution. And together, they create a far stronger picture than any single ratio ever could. But investing is always forward-looking. Markets don't reward companies for what they achieved last year. They reward what investors believe they'll achieve next. Which means there's one final piece missing. What are the latest quarterly results telling us? Has management's recent execution strengthened the long-term story? Or are there early signs that the narrative is beginning to change? The future is what markets pay for. So far, we've looked at the company through the eyes of a business owner. Now let's look at it through the eyes of the stock market. Because the stock market doesn't reward companies for what they achieved yesterday. It rewards what investors believe they can achieve tomorrow. That's an important distinction. Imagine two mango orchards. Both produce the same number of mangoes today. But one orchard has young trees that are expected to bear fruit for decades, while the other has aging trees nearing the end of their productive life. Even though today's harvest is identical, most buyers would willingly pay more for the first orchard. Stocks work exactly the same way. The market isn't buying today's earnings. It's buying tomorrow's possibilities. That's why quarterly results matter, not because they change a business overnight, but because they either strengthen or weaken expectations about the future. When we look at Shankara's recent performance, one message becomes clear. The company isn't trying to reinvent its business. Instead, it's becoming better at executing the business it already understands. That's often a healthier sign than dramatic transformation. The recent numbers suggest that growth is being supported by a combination of stronger demand, expanding customer reach, and improving operational efficiency rather than one extraordinary event. This is important because sustainable businesses usually improve gradually. They don't depend on miracles. Management's commentary follows a similar pattern. Rather than chasing aggressive expansion at any cost, the focus continues to remain on disciplined growth, strengthening the retail network, improving operational efficiency, and deepening relationships with customers and suppliers. That may not sound exciting, but experienced investors often prefer consistency over excitement. Because extraordinary promises are easy. Consistent execution is difficult. This brings us to an important investing principle. Businesses rarely become great because they make one brilliant decision. They become great because they avoid making many poor ones. Every sensible capital allocation decision, every efficient warehouse, every improvement in inventory management, every profitable store. These small decisions compound over time. Compounding isn't limited to money. Businesses compound too. Operational improvements compound. Customer trust compounds. Management experience compounds. And eventually, those improvements begin appearing in financial statements. One encouraging signal is the company's continued focus on capital discipline. Many businesses grow rapidly by borrowing heavily. For a while, growth looks spectacular. But when business conditions weaken, debt begins controlling the business instead of supporting it. Shankara has generally taken a more measured approach. Growth has been accompanied by balance sheet discipline rather than aggressive leverage. That gives management flexibility. And flexibility becomes especially valuable during uncertain economic periods. The company has also continued investing in areas that strengthen its competitive position rather than simply increasing size. That's an important difference. Growth for its own sake rarely creates shareholder value. Growth that improves efficiency often does. Now let's shift to a topic that every investor eventually asks. Is the stock expensive? Interestingly, this is the wrong question. The better question is, expensive compared to what? Compared to yesterday's earnings? Compared to competitors? Compared to its future growth? Or compared to its intrinsic value? This is why professional investors rarely depend on a single valuation ratio. Let's start with the most familiar one, the price-to-earnings ratio, or PE. Think of it as the price you're willing to pay for a stream of future earnings. A higher PE usually means investors expect stronger growth ahead. A lower PE may indicate lower expectations, or simply that the market hasn't fully recognized the opportunity yet. Neither is automatically good or bad. Context matters. Now consider the PEG ratio. If the PE ratio tells us how much we are paying, the PEG ratio asks whether future growth justifies that price. Imagine buying two identical apartments. One is in a fully developed neighborhood. The other sits beside a new metro station, an upcoming business district, and expanding infrastructure. Both may cost the same today, but their future potential is very different. That's exactly what the PEG ratio tries to capture. Next comes price to book, often called PB. For manufacturing companies, book value can provide useful insights because factories, land, and machinery form a large part of the business. Distribution businesses are different. Much of their value comes from relationships, execution, supplier networks, and customer trust. Those assets rarely appear on a balance sheet. So while price to book remains useful, it should never be viewed in isolation. Institutional investors also pay attention to enterprise value and EV/EBITDA. These measures look beyond the share price and evaluate what it would actually cost to acquire the entire business, including its debt and cash position. They're especially useful when comparing companies with different capital structures. Then there's the valuation model many investors consider intellectually elegant, discounted cash flow, or DCF. Although the name sounds intimidating, the underlying idea is beautifully simple. Imagine buying a fruit orchard. You aren't paying for this year's harvest alone. You're paying for every harvest the orchard is expected to produce over many years. A DCF model applies exactly the same thinking to a business. It estimates what future cash flows may be worth in today's money. Of course, no one knows the future perfectly. That's why DCF isn't about predicting one precise value. It's about understanding how today's price compares with reasonable future expectations. This naturally leads to another timeless investing principle: margin of safety. Imagine crossing a bridge. Would you prefer driving a truck weighing exactly the bridge's maximum capacity, or one comfortably below it? Most people instinctively choose the second option. Investing follows the same logic. Because the future is uncertain, investors often prefer buying businesses at prices that leave room for unexpected challenges. A reasonable business bought at an unreasonable price can still become a disappointing investment. Likewise, an excellent business bought with an adequate margin of safety often gives investors time for the business to prove itself. So where does all this leave us? After looking at multiple valuation approaches, one conclusion begins to emerge. The market has recognized that Shankara is improving. It is no longer an overlooked story. But neither does it appear to be priced purely on optimism. Future returns will increasingly depend on management continuing to execute well rather than investors simply becoming more enthusiastic. And that's exactly how long-term wealth is usually created. Not by buying fashionable stories, but by owning businesses that continue becoming stronger while the market slowly adjusts its expectations. At this point, we've connected almost every piece of the puzzle. We understand the business, the industry, its competitive advantages, its financial quality, its recent execution, and the way the market is valuing those strengths. But investing is never about upside alone. Every business, no matter how impressive, faces uncertainty. The real question isn't whether risks exist. It's whether those risks are fully understood before the market begins to worry about them. That's where our final act begins, not with optimism, but with the discipline of asking one uncomfortable question. What could change this entire investment story? Next, what could change the story? Understanding the risks before the market does. Every successful investor eventually learns one lesson. The biggest mistakes rarely happen because we miss the opportunity. They happen because we ignore the risks. Until now, we've deliberately looked at everything working in Shankara's favor. Now let's do something that professional investors do before committing capital. Let's argue against our own investment thesis. Not because we expect the business to fail, but because every investment deserves to be tested from both sides. Charlie Munger once said that he liked to know where he was going to die, so he would never go there. The idea sounds humorous, but it's remarkably practical. Understanding what could go wrong often protects investors more than knowing what could go right. The first risk is the industry itself. Although India's long-term construction story remains strong, construction has always been cyclical. Imagine owning the best umbrella shop in the country. Excellent products, outstanding service, loyal customers. But if there is no rain for 2 years, sales will still suffer. The business hasn't become worse. The environment has changed. Construction behaves in much the same way. Higher interest rates can slow housing demand. Developers may postpone projects. Industrial investment can become cautious. Government spending may shift priorities. When that happens, demand for building materials naturally slows. This doesn't necessarily invalidate the long-term opportunity, but it reminds us that even strong businesses cannot completely escape economic cycles. The second risk comes from the nature of distribution. Unlike luxury brands, distributors usually operate with relatively thin margins. Imagine earning only 3 or 4 rupees for every 100 rupees of sales. Now suppose transportation costs suddenly increase. Fuel becomes expensive, or wages rise sharply. Small changes in costs can have a noticeable impact on profitability. That's why operational discipline is so important. In businesses with thin margins, efficiency isn't an advantage. It's a necessity. The third risk is commodity price volatility. Steel prices don't remain constant. Neither do transportation costs or other input prices. Imagine filling a warehouse with inventory today only to see prices decline sharply next month. The value of that inventory immediately changes. The opposite can happen as well. Managing inventory in such an environment becomes less about predicting prices and more about responding quickly when conditions change. Good management cannot control commodity prices. It can only control how efficiently the business adapts to them. The fourth risk is competition. The construction supply chain is evolving rapidly. Traditional distributors continue improving. Large organized retailers are expanding. Manufacturers are strengthening their own dealer networks. Technology platforms are making procurement easier. Competition doesn't always destroy businesses. More often, it quietly reduces future profitability. The challenge for management is not simply growing revenue. It is maintaining efficiency while the competitive landscape continues changing. Then comes technology. Every industry eventually faces the same question. Can technology replace the existing business model? Banking changed. Retail changed. Travel changed. Construction is changing too. Customers increasingly compare prices online. Digital procurement is becoming more common. Artificial intelligence may improve inventory planning and forecasting. But construction materials are fundamentally different from digital products. Steel cannot be downloaded. Roofing sheets cannot be delivered through software. Warehouse, logistics, quality inspection, and physical delivery will continue to matter. Technology is therefore more likely to improve distribution than eliminate it. The businesses that adopt technology early will probably strengthen their competitive position. Those that resist change may gradually fall behind. Another important risk lies much closer to home. Management execution. As businesses grow larger, complexity increases. Opening one store is relatively straightforward. Managing hundreds of locations across multiple states is very different. Processes become more complicated. Hiring becomes harder. Maintaining culture becomes more challenging. The skills required to build a 500 crore rupees company aren't necessarily the same skills needed to manage a 10,000 crore rupees business. Growth demands continuous evolution. Another area investors should monitor is working capital. Earlier, we discussed improving inventory efficiency as one of the company's strengths. But strengths require constant maintenance. If inventory begins rising too quickly, if customers delay payments, or if cash remains tied up inside operations, the pressure often appears in cash flow long before it appears in reported profits. Institutional investors pay close attention to these signals because they often provide early warning of changing business conditions. Then comes valuation risk. This is perhaps the most misunderstood risk in investing. Imagine buying a beautiful apartment. The apartment remains exactly the same for 5 years. Nothing about the property deteriorates. Yet you still lose money. How? Because you paid far too much in the first place. The quality of the asset never changed. Only the purchase price did. Stocks behave exactly the same way. Even an outstanding business can produce disappointing returns if expectations become unrealistic. That's why investing is always about the relationship between price and value, not quality alone. Finally, there's the one risk every investor carries but rarely recognizes. Human psychology. Markets are made of people, and people are emotional. When a stock performs well, we naturally search for information that confirms our optimism. Psychologists call this confirmation bias. When recent growth looks impressive, we begin assuming it will continue forever. That's recency bias. When prices fall sharply, fear often convinces us that something must be fundamentally wrong. When prices rise rapidly, excitement persuades us that opportunities will never end. The business may not have changed at all. Only our emotions have. The best investors recognize this difference. They don't become optimistic because prices rise, nor pessimistic because prices fall. They continuously ask one simple question. Has the business changed, or has only the market's opinion changed? That single question prevents countless mistakes. After examining every major risk, an interesting conclusion begins to emerge. None of these risks appear unusual. Most are the natural challenges faced by well-managed distribution businesses. The question is not whether these risks exist. The question is whether management continues executing well enough to stay ahead of them. And so far, that appears to be the story we've been following from the very beginning. Execution, not excitement. Discipline, not speculation. Which brings us to the final piece of the puzzle. Because businesses change gradually, but stock prices sometimes move dramatically. Why? Why do institutions often recognize opportunities before the broader market? Why do trends develop long before headlines appear? And why does the market sometimes reward or punish a company even when very little has changed inside the business? To answer that, we need to move beyond financial statements and enter the fascinating world of market psychology, where expectations often influence prices just as much as fundamentals. Why the market moves before the business does. By now, we've understood almost everything about the business. We've explored India's structural growth, the industry's long runway, Shankara's business model, its competitive advantages, its financial performance, and the risks that could change the story. But there's still one mystery left. If businesses evolve slowly, why do stock prices sometimes move dramatically in just a few weeks? The answer lies in one simple idea. The market doesn't wait for the future. It tries to anticipate it. Imagine you're buying farmland. You aren't paying for this year's harvest alone. You're paying for what that land could produce over the next 10 or 20 years. The stock market works exactly the same way. When investors buy Shankara Buildpro, they aren't buying last year's revenue or last quarter's profit. They're buying a belief. A belief that India's construction story will continue. A belief that organized distribution will become more important. A belief that management can keep executing better than its competitors. That's why share prices often move long before annual reports fully reflect the change. Markets constantly try to pull tomorrow into today's price. Sometimes they succeed. Sometimes they get ahead of reality. And sometimes they completely misunderstand it. This is why investing is as much about psychology as it is about mathematics. Let's understand how that psychology unfolds. Most successful companies go through 3 distinct phases. The first phase is discovery. This is when the business quietly starts improving. Revenue begins growing. Margins become healthier. Capital allocation becomes more disciplined. But very few people notice. The company receives little media attention. Analysts rarely discuss it. Volumes remain ordinary. This is often where long-term institutional investors begin paying attention. Not because the company is popular, but because it isn't. The second phase is accumulation. Imagine trying to buy an entire apartment building. You wouldn't purchase every apartment on the same day. Doing so would immediately push prices higher. Large institutions think the same way. When they identify a business they like, they usually build their position gradually. Sometimes they buy. Sometimes they pause. Sometimes they wait for quieter periods before adding again. To the average investor, nothing unusual appears to be happening. But beneath the surface, ownership slowly changes. This patient behavior often explains why fundamentally strong companies drift upward long before they become household names. Only then comes the third phase. Recognition. This is when the broader market finally notices what early investors had already seen. Analysts publish reports. Financial media begins discussing the company. Retail investors discover the story. Volumes increase. The narrative spreads. Ironically, many investors become interested only after the easiest part of the journey is already behind them. Behavioral finance explains why. Human beings naturally seek social confirmation. We feel more comfortable buying something after everyone else begins talking about it. The same instinct that helped humans survive in groups can become expensive in investing, because markets usually reward patience before they reward popularity. Another fascinating concept is something George Soros called reflexivity. Although the word sounds complicated, the idea is surprisingly simple. Sometimes a rising stock price can actually strengthen the underlying business. Imagine two companies wanting to raise money for expansion. One enjoys strong investor confidence and a healthy market valuation. The other struggles with weak market perception. Which company finds it easier to attract capital, negotiate with suppliers, and recruit talented employees? Usually the first. Confidence creates opportunities. Those opportunities strengthen the business. A stronger business creates even more confidence. The cycle feeds itself. Markets don't simply reflect reality. Sometimes they help shape it. Of course, this doesn't mean stock prices only move upward. Corrections are part of every healthy market. Think about climbing a mountain. Nobody reaches the summit in one continuous sprint. There are pauses, rest stops, moments to recover before continuing higher. Financial markets behave in much the same way. Periods of optimism are often followed by periods of doubt. Prices pause. Some investors lose patience. Others use that time to reassess whether the business itself has actually changed. Professional investors understand an important distinction. Price movement and business performance are not the same thing. In the short term, prices are influenced by emotions. In the long term, they are anchored by business performance. Benjamin Graham captured this perfectly when he wrote that the market is a voting machine in the short run, but a weighing machine in the long run. Every day, investors vote using hope, fear, excitement, and uncertainty. Over time, however, businesses are weighed by something much more objective: revenue, profit, cash flow, returns on capital, management execution. Eventually, the fundamentals take control. When we step back and connect everything we've learned, a remarkably consistent picture appears. India continues investing in infrastructure and urbanization. That creates long-term demand for organized building material distribution. Shankara has spent nearly 3 decades building a nationwide network based on execution rather than exclusivity. Its financial performance increasingly reflects that operational discipline. Management has largely remained focused on capital allocation rather than aggressive expansion. The market has begun recognizing those improvements. But the story is still far from complete. Future success will depend on one thing above all else: whether the company can continue creating value faster than expectations rise. Because that's ultimately how markets work. Businesses create value. Investors create expectations. Share prices constantly attempt to balance the two. And when value grows faster than expectations, long-term wealth often follows. As we reach the end of this journey, perhaps the most important lesson isn't about Shankara Buildpro at all. It's about how every great investment should be analyzed. Not by asking whether the stock will rise tomorrow, but by asking whether the business is becoming stronger year after year. That single shift in perspective separates traders from owners. And owners, more often than not, are the ones who benefit most from the power of compounding. So before you make your own conclusion, leave yourself with 3 simple questions. If the stock market closed for the next 5 years, would you still be comfortable owning this business? What evidence would make you change your investment thesis? And finally, are you investing because the business is improving or because the stock price already has? The answers to those questions won't simply help you understand Shankara Buildpro. They'll help you evaluate every company you study in the years ahead. Because successful investing isn't about predicting the future with certainty. It's about understanding businesses deeply enough to make better decisions while the future is still uncertain. The business behind the stock. Let's return to where this journey began. Not with Shankara Buildpro, not with steel, not with construction, but with India. We started with a country investing in highways, industrial corridors, affordable housing, and manufacturing. Along the way, we discovered that these projects aren't just changing skylines, they're reshaping the economy itself. That larger transformation led us to a company that rarely dominates headlines, yet quietly plays an essential role in keeping that engine running. We learned that Shankara Buildpro isn't simply a distributor of building materials. It is a business built on execution, relationships, efficient capital allocation, and decades of operational learning. We explored an industry supported by powerful structural trends, but also challenged by economic cycles. We examined how the company's competitive advantage comes not from patents or monopoly power, but from thousands of small decisions executed consistently over many years. The financials showed that this operational discipline is increasingly visible in revenue growth, improving returns on capital, stronger cash generation, and a healthier balance sheet. We also recognized that every investment carries uncertainty. Competition evolves. Commodity prices fluctuate. Economic cycles change. Management decisions matter. And sometimes, even excellent businesses can become disappointing investments if expectations move ahead of reality. Finally, we stepped into the world of market psychology. Because stock prices don't simply reflect businesses. They reflect expectations about businesses. Those expectations rise and fall every day. Business fundamentals usually change much more slowly. And that difference creates both opportunity and risk. Perhaps that's the biggest lesson from this story. Successful investing doesn't begin by asking, which stock should I buy? It begins by asking, what kind of business am I becoming a partner in? Because when you understand the business deeply, daily price movements become less intimidating. You stop reacting to headlines. You start paying attention to evidence. Before we conclude, leave yourself with 3 questions. Not just for Shankara, but for every company you analyze in the future. First, if the stock market closed tomorrow and remained closed for the next 5 years, would you still feel comfortable owning this business? Second, what evidence would convince you that your investment thesis is no longer valid? Not because the share price fell, but because the business itself changed. And finally, are you investing in a durable business with improving fundamentals? Or are you simply following a story that has become popular? Those questions don't guarantee successful investing, but they help you think like an owner instead of a spectator. And over the long run, that mindset often becomes a powerful advantage. Thank you for spending your time with us. If this voiceover helped you understand not just a company, but also the thinking process behind evaluating a business, then we've achieved our goal. Because the real objective was never to tell you what to buy. It was to show you how to think. And in investing, that's often the most valuable lesson of all.
Don't forget to like and subscribe.